Morning, everyone. Glad to see everyone joining us this morning. Again, this is Bryan Fryar with the Tennessee Valley Federal Credit Union, sales manager in the mortgage department at TVFCU. This morning, I'm being joined by mortgage originator Jennifer Cheatham. Good morning, Jennifer. How are you?
Good morning, Bryan. I'm doing good.
Good, good. Great to have you here with us. I know you're located a little bit north of us here, and I'm in downtown. Tell everybody where you are currently right now.
I am in Benton currently.
Benton, Tennessee. So glad to have you with us this morning. We've got a great topic. We're going to be talking about mortgage tips and avoidances before and during the mortgage loan process. We get a lot of questions about this. Pre-qualifying, purchasing, refinancing. Like some of the things: should I pay off my credit cards before or during the loan process? Is it okay to buy a car when buying a house? We're going to touch on all those subjects today and those topics and try to answer some of your questions. First off, I just want to give an intro about myself. Again, my name is Bryan Fryar. I'm the mortgage sales manager here at TVFCU. I'm responsible for the mortgage originators and loan officer assistants here at TVFCU. I have a staff of 11 originators and 3 mortgage loan officer assistants. As with everything here at TVFCU, we are locally owned and operated. We're owned by our membership, being a credit union. All of our decisions, all of our underwriting, processing is done here locally. I'm located at the main office at 535 Chestnut Street, downtown Chattanooga. Jennifer is one of my mortgage originators. Jennifer and I have known each other for many years. I've been in the mortgage business going on about 23 years now, in origination, management, etc. So I'm going to hand it over to Jennifer and just tell a little bit about yourself there, Jennifer.
Well, I'm Jennifer Cheatham, and I have been with Tennessee Valley Federal Credit Union for going on 16 years now. I've been doing mortgage for half that time, about 8 years, and love working for Tennessee Valley Federal Credit Union.
Great, great. And Jennifer does a fantastic job. She covers the Cleveland area, Benton, all the way up to Athens. I know you have a partner there who everybody has seen in our previous seminars, Wendy Carter. So that's kind of your Cleveland partner there. So between Jennifer and Wendy, if you're a Cleveland resident, Benton, Athens, anywhere surrounding that area, or even in downtown Chattanooga, even Georgia, Wendy and Jennifer can definitely take care of you, along with our other originators here at TVFCU. So great to see you here with us, Jennifer. We're going to get started. We've got a number of questions. A lot of people had registered for our seminar, and we want to kind of touch on some of these questions. And whenever we came up with this idea of having this topic, we didn't want to be negative. We want to be on the positive side. But we do see a lot of things that some borrowers will do that we really want to try to see and let everybody know that you want to avoid. You want to make sure you're not making these same mistakes, and also maybe planning ahead of time. I know Jennifer, being in the origination side, you see some of the mistakes that borrowers do, and I know, especially here the past year and a half or so with lower rates, we're seeing a whole lot more borrowers coming in the market and refinancing or purchasing. So do you see those mistakes from time to time? So we want to kind of touch on those, and Jennifer's going to, she may interrupt me every now and then and say, hey, Bryan, I want to bring up this topic I've noticed, because she's in it day in and day out working with borrowers and everything in our membership. So let's get started here. And some of these questions are really, really good. We might be a little redundant on some of the things we talk about, so please bear with us. But first, I'm going to touch on one question here. How do I get a mortgage with bad credit? I do get this quite often over the years I've been in this business. Mainly getting a mortgage, you want to put yourself in the best position possible to get the best terms possible. And that means you want to, if you have some issues on your credit, you want to go and get copies of your credit report. Now, when I say copies, there are 3 different credit bureaus. They're Equifax, TransUnion, and Experian. And as Jennifer knows this, in the mortgage world, whether it be TVFCU or another institution, generally the mortgage lender is going to pull all 3 credit bureaus. So if there's something showing up on all 3 of your credit bureaus that's a negative, or on 1 or 2 of the credit bureaus, you'll definitely want to address that and see if you can't get that taken care of or cleaned up. Some things like Jennifer, collections we see, medical collections are a big one. Delinquent payments. If you've had some delinquent payments, you want to make sure you're making your payments on time. What else do we see? Tax liens. We see those sometimes. Those need to be paid. Any type of, if you've had a bankruptcy in the past, you want to make sure that you've gotten past the bankruptcy and you're reestablishing credit to rebuild those trade lines, etc. So first thing I always tell people to do is go to annualcreditreport.com. By law, the federal government has set up a website where it links you to all 3 credit bureaus, and you get a free copy of your credit report. You can do that, 1 per credit bureau per year. Free credit report. So you'll want to go to annualcreditreport.com, get copies of all 3, go through your credit reports, see if there are any negative items showing up that you'll need to get cleared up to improve that credit. Because that leads me to my next question: what score is best to have? And I don't know if Jennifer tells her members this, but I always tell people you want the best credit score possible. I mean, but generally you'll want to have a 740 or better credit score to be able to get the best terms, best pricing, best interest rate, etc. If you're up in the 800s, you're even better. That's great. But generally 740 or better credit score. Below that, maybe be more requirement for down payment, reserves or something like that. Interest rate may be a little bit higher. So definitely want to try to target that 740 or higher credit score. Jennifer, I think you had some questions on there. You want to go through some of them that you wanted to answer for some of our listeners?
Yes. Well, and another thing about the credit score also, our in-house, our portfolio loans, if your credit score is 720, you
Correct.
can do 100% financing, but it has to be at least 720.
Yeah,
So.
yeah, correct. Yeah, that's one of the things in our programs. We've got a little bit of leeway as far as credit scoring and pricing. Definitely, you want to look at your credit, get it as good as you can, then talk to your mortgage lender, especially if you're wanting to buy a house and get pre-qualified, or even refinancing. We can talk to you about that and see what best terms we can get you. But yeah, Jennifer's right. With our portfolio lending we do here at TVFCU, we can do a little bit a lower credit score. Still, 720 is a good credit score, and you can get some really good terms with us. Let's see here. Another question. How early should I apply for a loan when looking for a home? Jennifer, you want to take that one?
How early should I apply for a loan when looking for a home? Okay, so first you want to check your budget, see what's in in your budget that you can spend. Make sure that your credit is established and you have, a pretty good credit score. And you have some savings because you may need a down payment, you may not. But even if you don't need a down payment, you're going to have closing costs. So, save all that you possibly can. And when you think you're ready, get pre-approved. In today's world, realtors won't even take you to look at a house if you're not pre-approved. So you want to get pre-approved. And once you're pre-approved, that's good for 60 days. Yeah. So I highly recommend getting pre-approved.
Yeah. And with TVFCU, our pre-qualifications, they are good for 60 days. In some circumstances, we can extend that without having to repull your credit. The reason lenders had to put a time limit on that is because your credit report's only good for a certain period of time. So because after a while, they become outdated and they have to repull credit. You want to try to avoid that if at all possible. Getting a budget, everything, getting your credit in line, and then knowing what you're looking for or wanting to refinance, and then talking to your lender about applying and getting pre-qualified. And pre-qualified is a big deal, especially in today's market. Today's market's really, really big. Let's see here. One question I had on here: is it better to have a larger down payment or to have all your debt paid off and no down payment? That's actually going to be specific to your situation, to be honest with you. You'll definitely want to talk to your lender, hopefully Jennifer, but you want to have them look at that. Usually when it comes to underwriting or doing a mortgage loan, the larger the down payment, the better terms you're going to get sometimes. However, like Jennifer said, we have loans that were no down payment, and you may want to pay off some debt with that money you have and not use that money for a down payment. So it's definitely going to be specific to your scenario, and you want to talk to your originator and see what might best work out for you. Also, too, keep in mind, paying off debt and everything. we do have to watch out for debt to income ratios. So you may have some debt outstanding, and in order to afford that $250,000, $300,000 house, your debt ratio may be too high. So you may need to pay off some debt. That way you can qualify. So, and that does come in handy, especially with TVFCU, since we do have options where you don't have to put a down payment down, and you can use those funds if you need to pay off some debt. And also, Jennifer touched on too about the down payment closing costs. Another thing too that borrowers need to be aware of, especially if you're doing a purchase, two ways to pay for closing costs: either the seller pays for it or the buyer pays for it. Seller pays for it. That's negotiated through your purchase price. And if you're using a realtor, which I highly recommend, you'll want to talk to your realtor about who's going to be paying for closing costs too, and talk to your lender too. So that's a big deal. Jennifer, I think we had another question here. How do lenders look at your income if you are self-employed and have some W-2 income? If you want to touch on that.
Well, we can always count W-2 income. Your self-employment income, we cannot count it unless you have 2 years history. So if you just have a little bit of self-employed or a little bit of W-2 and most of your income self-employed, but you've only been self-employed for 6 months or 12 months, you will need to wait until you have that income for at least 2 years.
Yeah. And we run this scenario sometime. You have someone, let's say that, say you're an engineer and you work for TVA, and you get a W-2 and a pay stub, and you've been there for 7, 8, 10, 20 years, but you might have a side business too. In order to count that income from that side business, you'll need to have that income reported for at least 2 years. So something to keep in mind and of course, if all your income comes from your self-employment, 2 years is generally the benchmark, and we'll need to see your personal and business returns in most cases to calculate that income. So big deal, especially with people that are self-employed. I think I've touched on this quite a bit in my other seminars. My father being self-employed for 40-something years, he had to do his own tax returns and try to report that income. I know a lot of people write things off, but when it comes to the world of residential mortgage lending, we are definitely going to have to look at those tax returns pretty close just to make sure we can qualify you. So,
another question we had: if my husband is the only one bringing in income, does that matter? No, it does not matter as long as that income, you qualify, both of us qualify on that income. And if you have debt that your husband don't have, it may be best if he applies for the loan by himself. Even if he's the only one on the loan, you can still be on the deed to the house.
Yeah.
And another thing that works with is if you have good credit and your spouse does not. Well, if you qualify for the loan on your own, then it's best to leave the spouse off, and you can both be on the deed, but just the one with the best credit be on the mortgage loan. And I had someone the other day that didn't realize with our auto loans, we take the best score. The other one doesn't matter. On a mortgage loan, we pull all 3 of your bureaus and we go with the middle score, and it's the lowest of the middle score. So it does matter, both borrowers, what your credit scores are.
Correct. And that's going to be with any lender, especially if they're doing secondary market loans, Fannie Mae, Freddie Mac, FHA. It's going to be pretty much the same with everyone. That's the standard in the mortgage world. And then also talking about spouses. In a perfect world, if you're married, you want to have your spouse on the loan with you. But there are circumstances. I think we had one recently. I don't know if it was your loan. It may have been another one where the primary borrower credit was excellent, but the co-borrower had a recent bankruptcy and they'd just gotten married. So the credit had taken a big hit. And in circumstances like that, it unfortunately the loan was a denial as it was submitted to us. But then the borrower decided to reapply in just their name without the spouse on there, and we were actually able to get them qualified in that case. But yeah, those cases come up like that. 2 spouses. One of them may not have the best credit, the other one does. That's something you'll want to talk to your originator about. Hopefully before you apply. But do keep that in mind. But if you both have great credit, hey, wonderful. Here's another question, Jennifer. If you want to touch on this one, how long does the process usually take from application to final approval?
Okay. Normally 30 days. We like to get loans closed in 30 days, but in today's world, in today's market, and with everybody refinancing, everybody purchasing homes, that pushes the appraisers out. So sometimes, it's 3 to 4 weeks before they can get the appraisal. So if it's, if we don't get the appraisal back for 3 to 4 weeks, most of the time we cannot close in 30 days, but we like to close in 30 days if at all possible.
Yeah, and I want to kind of touch on that. Me being in the business, you've been in business a long time too, Jennifer. We see the ups and downs of the market, and right now we are a very high ever since March of last year. So mortgage companies like TVFCU and other companies, they do have to use independent third-party entities such as title companies, appraisers, to do the work to finalize the loan. There are a finite amount of appraisers in the United States in the Southeast Tennessee, North Georgia area. So when you have all these lenders requesting these requests for appraisals, the appraisers can only do so much. So do keep that in mind, especially if you're working your realtor. A lot of the realtors in this area we work with do realize that. They do know that it's taking a little bit longer time, especially sometimes in the more rural areas. There aren't as many appraisers out there, or appraisers just don't go out to the more rural areas, or if they do, it may take them a while to get there. Okay, so do keep that in mind. We had one, I think it was on the Kentucky border, north of Chattanooga. It was, I think they said it was going to take 6 to 8 weeks to get to us since it's such a rural area. So we tried to find another appraiser, and we did find another one, but I think the soonest we were going to get that one back was going to be about 3.5, 4 weeks. So did have to talk to their realtor and the seller to get a extension on that closing, just because couldn't get an appraisal sooner. But in most cases, we are able to get them in and get them closed within 30 days. We even got an appraisal back the other day. We ordered it. I think we got it back in 5 days, I believe, 4 or 5 days. So in some cases, yeah, we'll try our best to get them done sooner if we can. But do keep that in mind if you're looking at refinancing, purchasing, 30 days. Also, too, Jennifer, if you want to talk about refinances and what happens when you close a refinance loan before you get your money.
There, you have to wait 3 days. There's a rescission period, so you will not get your money at closing. It will be 3 days later.
Correct, and that will be whether it's a home equity line of credit or a second mortgage or what we call a rate term refinance, where you're not taking additional cash out or consolidating debt, or a cash out refinance. Federal law requires a 3-day right of rescission after closing. So basically, when you close your loan, you have to wait 3 days before that loan goes into effect. That rule was put into effect many, many years ago, even before I got in the mortgage industry in the late 90s. Basically, when you're refinancing, the way the regulators look at it, the government looks at it, is you're refinancing your home, then you should be given 3 days to look through the paperwork to decide if you really want to go through that loan, or you can rescind. And the loan won't go into effect. Again, it doesn't go into effect until 3 days after closing. Those are 3 business days, excluding Sundays and federal holidays. Okay, so do talk to your lender. If you were, and we run into this quite a bit. I know Jennifer's run into this many times. Borrowers are refinancing, taking cash out because they need that money to do something. Either they've got a contractor lined up to put in a pool, or they're going to use that money and the equity in their home to buy a piece of property adjacent to theirs, or use it for something else. So they have a deadline when they need that money. You really need to talk to your originator about when you need those funds, because we're going to need to you're going to need to put that 3-day right of rescission in with that time period too, of the 30 days from closing, from beginning to closing and everything. So do keep that in mind. If you do need those funds, you need to let your originator know. We will try to rush as much as we can, but again, those timelines we can't get around. I know back when I first started in this business in the late 90s, people would try to or wanted to waive that right of rescission. I will say it's extremely rare then. It's even more rare now. It's almost impossible to waive that right of rescission. There's maybe 1 or 2 circumstances, and for convenience is not one of them. So they do not let you waive that right of rescission. So that's a tough one to get around. So
while we're talking about refinances and home equities are an excellent way to consolidate debt. to get money for home improvements. The rates are extremely low compared to credit card rates.
Yes.
But a thing to remember with home equity loans, there is no origination and no out of pocket, but that does not mean no closing cost. So many times when we say no origination or nothing out of pocket, people think no closing cost. There are closing costs, it's just minimal compared to a first mortgage.
Yeah, yeah. Generally, a lot of those closing costs on the home equity lines of credit are going to be the title fees, and with us, you get to choose the title company you want to use locally. And also too, TVFCU for the year 2021, we're still running our special where we pay for your appraisal if an appraisal is required. So that's another added benefit of being a member and doing a mortgage loan with TVFCU. TVFCU will cover the cost of your appraisal. So that good point, and especially with the home equity lines of credit. Those are great to use, for consolidating debt, needing cash out or something like that if you need it. But also too, we do refinances on a first mortgage or a cash out refinance where you can consolidate everything with your mortgage. We do those as well. So most of your mortgage lenders on those, I'll just touch on this, for a cash out refinance, will only allow you to go up to 80% of the appraised value of the home. We do that with our secondary market lender. But we also have an in-house loan where we can go up to 90% of the appraised value on a first mortgage cash out refinance if you qualify. So that's an added benefit. That's something TVFCU does. That type of loan is a loan that we keep in-house on our portfolio. So something we have an edge up on our competition. So, and also Jennifer, what's our loan to value for our home equity lines of credit and second mortgages?
100%. If your credit score is above 720, we'll go up to 100%.
Correct. Everything else being, you qualify with, you can go up to 100% of the appraised value. Now, if you owe a first mortgage, you'll be doing a home equity line of credit second mortgage. So the combined loan to value maximum is 100% if you qualify. So that's another added benefit. Something else, we have an edge on the competition here in our area.
Well, and Bryan's saying that we pay for the credit report. We save you over $500 on the credit report and your credit report and your appraisal. I mean,
Correct.
We've saved you over $500 on the appraisal and credit report. And we've seen appraisals as much as $1,000. So, I mean, It saves you a whole lot of money.
Whole lot of money. We're going to touch on two more questions, and then we're going to switch the discussion about what not to do once you've applied either for pre-qualification or you're in the loan process. Some big mistakes we see, and we want to make sure that people listen to this. Once you go that route, you do not need to do. So I want everybody to take some good notes on this when we touch on it. Let's see here. One question, and before we get to that, Jennifer, I'll let you answer this one. How do people qualify for a new mortgage while already having an open mortgage? Good question.
Okay. Yes, a very good question. We get this one all the time. If you qualify, if your income is enough and you qualify for 2 mortgage payments, you can actually get the new home and then sell your home. Most people, I know I wouldn't, most people don't qualify for 2 mortgages at one time. So you usually have to put both homes or your current home on the market, and you can do pending the sale of your current home. We have that one the most.
Yeah. And they call that a contingency. A lot of people, and they write that in their purchase contract. Just do remember, if you do have that contingency and you can't qualify with your current mortgage and you're doing a new mortgage, just do know that contingency, that current mortgage, that home does need to sell prior to our loan closing, or it has to be sold at the closing table at the same time. So keep that in mind. So if you're selling your home, you're wanting to buy another home, but you can't qualify with both payments, make sure that the home that you're selling does have to close prior to our mortgage loans in order for you to qualify. So, and then sometimes I have seen, I don't see it quite this much in this market, but where the contingency, the sale of their home falls through. Either their lender, wasn't able to get it done, or just something happened, appraisal didn't come back, or there's a problem with the inspection or something like that. That can cause you not be able to qualify with the loan you're working on. So keep that in mind. Always have a plan A, plan B. Best case scenario, worst case scenario. Before you start lining up all those movers and bands and make sure that, hey, if this doesn't go right, what am I going to do if this doesn't come through? Okay. Do make sure you have that plan B. We run into this quite often. We have people that
Mhm.
call us and they say, hey, my loan couldn't get approved through lender A there in Chattanooga, but they said TVFCU could do it. I don't have a home and I'm going to be out of a home in 2 weeks. We get that quite a bit. Got one yesterday, got one the day before that. Another lender couldn't do it. So at TVFCU, we're going to get it done. So I know I'm tooting our horn here, but we are looked at as a lender by other lenders. If they can't do it, call TVFCU. Let's see if they can get it done. In some circumstances we can, sometimes we can't, but we have a lot of leeway and we have some really good products to be able to get borrowers qualified. So it makes me feel good. Well, I hate it for the borrower, but I'm happy for the borrower too that they can go to TVFCU and we can get the financing they need. So let's switch gears right now. Let's talk about once that you get pre-qualified and you're looking for a home, or you have already started the actual loan process. You found a home, and we have your loan in processing, or if you're refinancing and we have your loan in processing, we've put together a list of do's and don'ts. This is a list of do's and don'ts, or a list of don'ts that we send out to our borrowers once we start the loan process. Just a reminder, hey, don't do this. Mainly it's don't do this until you talk to us first, okay?
Right.
But really don't do it, but if you feel like you need to or you want to do it, please talk to your originator first, okay? So I'm gonna go through these and I'm gonna take one. Jennifer's gonna take the next one. She and I have already talked about this, and we're gonna tell you what we don't want you to do and why, okay? First one, don't miss loan payments. That's a biggie right there. A lot of people may be refinancing and will be paying off their current mortgage lender, or we're going to be paying off some credit card debt or car loans, which is all well and good, but make sure you plan to make those payments just in case. The reason I say this is, let's say your appraisal gets delayed for some reason, or there's a title issue. Something came up on title and we're trying to get it cleared up. That may take time. And you're in the 30-day window there of loan processing. It may take longer, and it's out of our hands, it's out of your hands, it's just how it is. But do plan on continuing to make those mortgage payments. Do not put those off. Because if you put them off for a short period of time, you could incur late fees and interest, which you don't want to have to pay. B, if you go long enough, 30 days or more, it's going to show up as a negative on your credit, and in that case, it will definitely affect your loan approval. So again, have a plan. Plan A, best case scenario. Plan B, worst case scenario. Make sure you're making those payments and keep up to date on those. I have heard some borrowers say, well, my mortgage lender so-and-so said, don't worry about it. They'll get the loan done, and we'll close. And here I am, and it's not closing, and I'm going to be late on these payments, and they're scrambling trying to make the payments. Again, make sure you plan, regardless of whatever your lender says. Make those payments. I've been doing this for 23 years. I've always told people, yes, we are going to try to get your loan done and we will pay that off. But B, you need to make sure, just in case it's not done in time or something comes up, that you can make those payments and don't go late. I think Jennifer would definitely agree with me on that.
Yes.
Next one, Jennifer, I'll let you take this one.
Okay. Be careful before you consolidate your debt. Call us to discuss. You don't want anybody to pull your credit. It's going to be an inquiry. It could cause more debt. You may not have the right paperwork on the loan. There's just so many reasons. If you're going to consolidate your debt, you either need to have it done way before you ever decide to do a mortgage, or after, or if it's to do a home equity or something, let us pay off the debt with the loan.
Yeah. And in any of these circumstances, please call us first and talk to us first.
Mm-hmm.
Let us know. Don't do it and then we find out later, because a lot of mortgage lenders, they have what they call alerts whenever they're processing your loan. And if you have a credit inquiry on your credit, we're going to get alerted for it. And because we need to know if you're taking on new debt, because we have to include that debt in your debt to income ratios. So please be aware. Next question, avoid changing jobs or changing your job status from full-time to part-time. Again, talk to us first. This is a big one. Again, I've been doing this for a long time, 22, 23 years. I have never seen it like this. in my full career until the past 4, 5, 6 months. And I think everybody's been seeing the news. A lot of job openings, a lot of people are changing jobs. They're working at job A, they're making, decent money, but they found another employer that's paying more money. So we're seeing a lot of people job hopping to make more money. Sometimes in the same career field, sometimes a different career field. Or during the pandemic, they may have gone back to school and gotten a little bit more education. They may have gone and gotten their master's degree. Hey, they're going to go into a different job that pays more. Uh, However, when it comes to a mortgage loan, if you are changing jobs, that's a big no-no. We had one that we did a verbal verification of employment date prior to closing, and their current employer said they don't work here anymore. They left 2 days ago to go work somewhere else. So that put a big halt to the closing, threw a huge monkey wrench in everything. We had to scramble, and we were able to get that loan done. But again, in some circumstances, it may kill your loan and cause a denial. So definitely don't change jobs. Don't quit your job. If you get laid off, let us know as soon as possible. Okay. And we'll see what we can do. But do keep in contact. If you are thinking about switching jobs, let your originator know. That is a big deal. Again, we are seeing this. I'm almost once or twice a week sometimes. I'm seeing this. And we're trying to get this information out there. If you're talking to another lender, this is just good advice. Don't change jobs. If you are or thinking about it, do talk to your lender too. Okay. Next one, Jennifer, if you want to take this one.
Don't start banking at a new institution. We have to verify your funds for closing and your down payment. So if in the middle of the process you change from one banking institution to another, then we have to have the statements from both. And sometimes it gets very confusing and very hard to verify funds. So if you're thinking about changing banks, wait until after you close your mortgage loan.
Correct. And of course, hopefully you have your accounts here at TVFCU. I will say this.
Yes.
It's a lot easier for us to verify things if you do have your account here with TVFCU. So if you're looking at maybe purchasing here in the next few months, go ahead and come on over to TVFCU, put your money in there, let it, what we call a season, sit there for a while. And that way, when you do start the mortgage loan process, especially on a purchase, I'll just say it's a whole lot easier for us to verify those funds because, we've got them here. We can pull your statements and all that. So you don't have to send us your bank statements if they're TVFCU. We got them. Okay. So next one here, avoid buying a car, truck, boat, motorcycle, RV, or any large ticket item. Avoid getting pre-approved on these large items, nor let anyone make inquiries on your credit, getting pre-approvals, etc. This is another big one. I know with there's a lot of cash floating in the economy these days. People are making a little bit more money, and there's a lot of pent up purchasing going on there. People haven't bought anything. They've saved their money. They're going out and buying cars, but they have to finance them. Be very, very careful, especially if you've gotten pre-qualified to purchase a house. You go out and buy something, we're going to have to add that debt, and we will know about it. I mean, it's just one of those things that if anybody inquires on your credit, you go get a car loan, your lender is going to be notified, and we will have to count that new debt in your debt to income ratios. Could kill the deal. We had one the other day. This is 2 or 3 weeks ago. Going to the closing table, the gentleman the night before had gone out and bought a truck. He was closing at 10:30 the next morning. We got an alert on it on his credit report, and we had contact him. We were able to get the information we needed. Had to go back to underwriting. It did delay the loan for a little while, but we were able to get him qualified and move on. But again, if you're going to be buying that automobile, that boat, that RV, make sure you're doing that after you finish your loan or way prior to. And then we will have to count that in the debt income ratios. Again, that's another big one up there with the missing loan payments and not changing jobs, etc. Jennifer, if you want to take the next one.
Okay. Avoid buying furniture or household goods on credit. You're getting a new house, you're all excited, you want new furniture, but there again, that credit pull affects your affects your credit. That's another credit inquiry. That debt could affect your debt ratio and cause your home to, your loan to be denied. So I know you're excited about getting new furniture or new stuff for your house, but wait until after you have closed on your loan.
Yeah, very important. And like Jennifer said, people, you're excited. You want buying a new house or a newer home, and you want to furnish it. I get it. Hey, I bought, a couple homes in my life, and I completely understand that. But do talk to your lender before you do anything like that. Again, don't want it to affect your loan approval and you missing out on getting that home. So that nice new furniture, you won't be able to move it anywhere. So just a word to the wise. I was just a little quick note here. A few years ago, I saw a video that a realtor had posted on social media, and she said the borrowers were inside. She was the seller's realtor. The borrowers were inside checking out the house, final inspection on it the day before closing. But she said the sellers here just showed me their nice new SUV they had purchased earlier that day. So she said, she goes, I think we might hear something from the lender because I don't know if this closing is going to go through. So it was kind of funny, but it wasn't funny. So that realtor was very smart in noticing that. So you want to avoid, buying any big ticket items or anything like that during the loan process. Next question, avoid making large deposits into your bank account or making cash deposits. Don't shift your finances around. That's another big one. We do see that, especially if you're doing a purchase. You've got funds that need to be verified. Those funds are going to be used for either down payment or closing costs or both. We have to verify those funds. We have to know where that money is coming from to make sure those are your funds and they are not funds that are borrowed on a credit card or borrowed from someone down the street. And cash deposits, everybody says cash is king, but not in the mortgage world. Cash cannot be used. It's not verifiable, even though it's been put in your account. Can't use that towards closing costs or down payment. They have nicknames for that. They call it mattress money or freezer money. So if you do have money like that and you are planning to purchase a home, get that into a verifiable account as soon as possible and let it sit there. Let it season, okay? Because here's what you're going to run into. If you deposit in your account, your bank or credit union shows there was a cash deposit, we need your bank statements to verify those down payment funds. We get your bank statements, it shows a cash deposit. Sorry, those funds cannot be used for that down payment or closing costs. So word to the wise, cash is not verifiable, even if it is put in your account. If the underwriter sees that, they're going to question that. And if it is cash, it cannot be used. Also talking about making large deposits and moving money around. Any large deposits, underwriter is going to question that, so we will need an explanation of it, where those funds came from. They're going to need a paper trail, especially if those funds are going to be used for down payment or closing costs. We got to know where that money came from. Did you get that as a gift from a relative or a friend or something like that? We're going to question that. We are going to see it. Our underwriters, and this is anywhere in the mortgage business, just not TVFCU. We're not being mean. It's just underwriting standards, because it is risk. We've got to make sure if you are required to have a down payment or pay for closing costs, those are your funds. Now, that being said, if it's a gift, great. If you're getting a gift from a relative for your down payment, that's awesome. Do those all day long. However, tell your relatives, don't start moving that money around just yet, okay? Wait until you talk to your lender, because there are certain procedures you have to do, and there are certain documents that have to be filled out. There is a, what's it called, a gift letter, Jennifer, that has to be filled out by the donor. And in that gift letter, it does state that it is not to be paid back. It's not a loan. It is a gift. You are giving it. Your mom and dad are giving it to you to buy your home. It is a gift. It is not to be paid back. Okay. And again, paper trail. We have to have. And again, it's not just TVFCU. It's going to be any lender in the mortgage world is going to require that too. Okay. Jennifer, you want to take on the next one?
Don't spend the money you are going to use for your down payment or closing costs. So we have to verify in the beginning that you have the funds for your down payment or your closing. Like I said, you need those funds up front so that we know it's not going to hold up the loan. We don't want to wait until the end and find out that you don't have the money. So once we verify those funds, make sure that they stay set aside and you don't spend them, because then we're going to get down to closing and your loan could be denied at the end because you're $1,000 short or something.
Yeah. see that every now and then too. I had a really big loan we were working on the other day. Borrower, I think, had to bring a certain amount of money. It was like $30,000 or so they were going to be putting down. We get towards the end, and that money had been moved out of the account. But the borrower said, "Oh, I still have the money. I just moved it to a different account." Well, we didn't have documentation of that. It just put everybody in a panic. So in that
Mhm.
case, that borrower honestly should not have moved that money around. So because it did require them to go get other documentation. And it, again, could have avoided that if they didn't move it. So do keep that in mind. Don't be moving money around a whole lot. It gets harder to verify, and it will require you having to get more documentation to us. And again, that's any mortgage lender you're going to use. You're going to run into that. And let's see, one other item: avoid being a co-signer for anyone. Yeah, if you're working in the mortgage loan process or getting pre-qualified, and you've got a relative or a child that's wanting to buy a car or something like that, and they want you to be a co-signer, let us know before you do that. It could affect your loan approval because it's going to run your debt to income ratio up if you're a co-signer or a co-borrower on a note on a loan. So definitely, let us know that before you do that. Again, we're not saying you can't do it. You just need to talk to us first because we'll need to see what that payment is and how it's going to affect your loan. Okay. In a perfect world, we'd like for you to avoid that if at all possible. But if you absolutely have to, talk to us first. Okay. Um, um,
Well,
uh,
and on that one, all the time we get people saying, that's not my loan, that's not my debt. If it is on your credit report, we have to count it against you unless they've made over 12 payments and have proof of that. If
yeah.
not, we have to count that debt against you.
Yeah, yeah, very true, very true. And it's your name is on the note or on the loan document. You are a borrower. That does is counted against you. So do keep that in mind. Do keep that in mind. Um, there are a couple of things we don't have on our list here, but I'm going to kind of run through these we've run into recently. One of them, we had a borrower, and congratulations to them, they got married, but they got married the day before closing. So, which is okay, but we had to scramble and add them to some of the documents and everything for the closing. So, if you are going to be getting married or something like that, please let us know beforehand so we can prepare for that. Okay. And another one that goes with that too is name changing. Say if you recently got married and you're looking at changing your name, that's going to affect your pulling credit. It's going to affect loan documents, any of that during the loan process. Let us know if you're going to be legally changing your name or you're planning on doing it during the loan process. Please let us know because again, that can affect and it could put a monkey wrench in everything. And we just we have to stop what we're doing. We have to get everything taken care of. And I know everybody works. They have job. They have family. And it is a pain having to send documents to your lender when they're constantly asking for documents. And I get this a lot from friends and relatives. They're hey, I'm working with another mortgage company, and I sent them documents, and they keep asking for more. And why do they keep asking for more? Why didn't they know about this in the front end, Brian? I'm like, well, first problem was you didn't go with TVFCU. The second one is sometimes the documents that you send in when it goes to underwriting or it goes to your originator, it may raise more questions, like saying moving money around. You send us some bank statements from another institution, and then we look at it, and that money's not there. It's been transferred somewhere else. We're going to need the bank statements on where that money went to because we need that paper trail. Okay. One thing we do get, and Jennifer, you can probably talk to this, is someone fills out an application and they say they work for Blue Cross Blue Shield for the past 2 years, but then they send us their documents and we have their W-2s, but their W-2s are only for the past year. And the W-2s are they work for Chatham or something like that. So, we're going to need, that paper trail too of where you worked for the past 2 years, et cetera. So we do see that sometimes. People are like, well,
Right.
we worked there like 2 months. Okay, well, I understand that, but we have to have that timeline of 2 years in there too. Okay. And I think that's pretty much. Is there anything else, Jennifer, that you can think of? I think we run through a ton of information, and again, uh, there's always something else I always remember after we get off of these calls. I wish I just said this, but anything you can think of off the top of your head?
Can't think of anything we've not covered.
Yeah, I think just the main thing is if you're thinking about doing something, talk to your lender first. Keep those lines of communication open. And I just tell people, don't hide anything from us. We are your advocate. We are trying to get your loan done. We're doing our best
Mhm.
to get your loan done. The second person that wants this loan done more than you is us. We want
Right.
to get it done. That's what we're here for. We are member service oriented, and we try our best to do every loan. Again, that's what I tell everybody. My job as a mortgage sales manager, my job is to do as many loans as possible. And I work with my originators as much as I can. I get phone calls, emails all the time. Brian, hey, can we do this? Can we do this? And with what we do here at the credit union, being locally owned and decisions made locally, I can walk down the hallway and talk to my boss, or the underwriters are right here next door to me. I can talk to them and see if we can do these loans. Again, we're advocates for you guys, for our membership. We're trying to do as many loans as we can. We will do our best to try to get your loan done if we can. But as the saying goes, help me, help you. Uh,
Yes.
we want you to make sure when you're going through the loan process not to make any mistakes and avoid some of these common mistakes we get here. So
Yes. As Bryan says, ask us first. And the number one thing I get members to say is, I didn't want to bug you, or I feel like I'm bugging you, or I'm sending you too many emails. I always say, you could never bug me. That's why I'm here. I would rather you call me and ask than, something go wrong. So call me as many times as you need, email me as many times as you need.
Yeah, we have a full team here. Again, we have 11 mortgage originators, and Jennifer and Wendy being in the Cleveland area. And we also have loan officer assistants that help our originators too. We have loan processors here at TVFCU, and underwriters, our own closing department, our own servicing department. So we have a whole full department that's here for you, trying to do the best we can to get these loans done for you. So we're going to go ahead and wrap it up. We do have an announcement to make. We have a winner, Philip Wheeler, for our $100 Visa gift card drawing. Philip, thank you so much. Thank everybody for joining us today. And Philip will be in touch with you to get you that $100 Visa gift card. Congratulations. Also want to give a little bit of contact information here for the mortgage department here at TVFCU and for Jennifer. If you want to contact us, please call us at 423-634-3667 or at mortgage.support@tvfcu.com. That is the mortgage real estate department. Jennifer, if you want to give your contact information.
Yes, you can call me at 423-634-3662, or you may email me at jennifer.cheatham@tvfcu, or you can go online to tvfcu.com /Jennifer Cheatham.
Yeah, and you can always contact us through our website. Apply online at tvfcu.com. There is an icon at the bottom of the website that says buy a home. Just click on there. You can see our full team there, has their pictures, has their information, also has each individual links to apply. So we have originators that cover the whole Southeast Tennessee, North Georgia area. So you can apply if you're in East Brainerd. We have an originator in the East Brainerd area, Ooltewah, downtown, Ringgold, North Georgia. And again, we have two originators there in the Cleveland area. So again, we want to thank everybody for joining us. Jennifer, thank you. It's been fun.
Thank you.
I think had a lot of great information. Again, reach out to us if you have any questions regarding the mortgage loan process, what to do, what not to do. We'd be more than happy to answer any of your questions. So we're going to go ahead and end it. Thank you, everyone. Have a safe weekend, and great talking to you. And we'll see you next month. Bye.
Bye.